History shows that markets incorporate any expectations ahead of economic reports. So today we're going to take a look at why stocks don't always wait for the good news to come out before they rally during a bear market. So really the stock market is constantly pricing in new info, pricing in expectations for both companies and their earnings, as well as the economy. And because it looks so far into the future, it'll often start to turn around before the economic data does. So to put it simply, stock prices reflect future expectations, not so much what's happening now or even in the past. And this is why we believe that investors who look beyond after the fact headlines and stick to their game plan might be better positioned for long-term success. So we're going to take a look at this chart, actually a few charts from Michael Cembalest. He works for JP Morgan, where he really explored this relationship between markets and their performance and economic news when it comes out. And he put this out in a research note published back on October 19th. So I realize there's a lot here, so I'll leave this one up for a while. Now, each of these charts is a bear market, but to keep it simple, let's just look at the chart in the upper left corner first. So stock prices, reflected as the S&P 500 as the blue dotted line, tend to move upwards before we see improvements in earnings as the red line, or GDP in the yellow line, and even employment as the purple line. So when we zoom back out to the rest of the sample size here with all of the other bear markets, you can see that there's a general trend with the market bottoming before any of the other data. Now in the bottom right corner, we're looking at the latest bear market, the one that we're currently in. Now it's possible, obviously, stocks could fall below the October lows that we've already made. But the key takeaway is this. I wouldn't be surprised to see stock prices move upwards even as more bad news comes across your screen. And in fact, we're in a current environment right now where bad news is actually good news, as it would indicate that the Fed's actions are finally working to cool inflation. So quite literally, the market tends to get better in environments like this as the economy gets worse. It's really because the market is a leading indicator and economic data is a lagging indicator. So I hope at the very least this can provide some context to all the bad news that we get bombarded with on a daily basis. As always, stay the course, stay on point. Take care.